Have you noticed how things feel when they are off? Prices are climbing, markets are shaky, and the news can't decide if we're headed for a boom or a bust. It's like the world's economy is balancing on a tightrope, and every gust of wind threatens to knock it off course. But here's the burning question. Is 2025 the year it all falls apart? Some experts are pointing to clear warning signs, like mounting debt and global tensions. Others argue there's enough resilience to avoid disaster. So who's right? And more importantly, what does it mean for all of us? Let's unpack the story and see where we're headed. Current economic landscape. Right now, the global economy feels like it's running out of steam. Growth is slowing and the numbers back it up. In 2025, global GDP growth is expected to hover at 2.8%, the same as in 2024. But here's the thing. Before the pandemic, we were used to a much healthier average of 3.2%. That difference might not sound huge, but in a world where every fraction of a percent matters, it's a big deal. Let's talk about the US, the world's largest economy. In 2024, it grew by a respectable 2.8%. But 2025? Predictions suggest it'll drop to just 1.9%. That's a noticeable slowdown, especially for a country that drives so much global trade. And then there's China. Once the poster child for rapid economic growth, even it is starting to cool off. Experts predict its growth will fall slightly from 4.9% in 2024 to 4.8% in 2025. While still decent, it's far from the double-digit growth China used to boast. When the two biggest players in the global economy slow down, it's like a chain reaction. Trade weakens, supply chains tighten, and smaller economies struggle to keep up. Emerging markets, which often rely on exports to these giants, feel the squeeze the hardest. It's like a ripple effect, except this ripple might turn into a wave. Inflation is another thorn in the side. Despite central banks raising interest rates to combat it, prices remain stubbornly high in many regions. And when people have to spend more on essentials, there's less money left for everything else. This squeeze on consumer spending adds yet another layer of pressure on the global economy. Indicators of a potential economic crash. If the global economy were a car, the dashboard would be lighting up with warning signs. Here are the biggest red flags that have experts worried. First up, global debt. Right now, it's at record levels, higher than ever before. Governments, corporations, and households have all been borrowing heavily. During the pandemic, countries took on massive amounts of debt to keep their economies afloat. Now, they're struggling to pay it back. Here's the problem. When debt piles up, even a small interest rate hike can cause a financial chain reaction. Imagine a company barely making its debt payments. If interest rates rise, those payments get bigger, potentially forcing layoffs, budget cuts, or even bankruptcies. Multiply that across thousands of companies and households, and you can see why debt is such a big deal. Then there's geopolitical tension. The war in Ukraine is still raging, and it's disrupting energy supplies across Europe and beyond. Add in ongoing trade disputes between the US and China, and you've got a recipe for global uncertainty. Geopolitical conflicts don't just disrupt trade. They also shake investor confidence, making financial markets more volatile. Speaking of volatility, let's talk about the stock market. Over the past year, we've seen massive swings in major indexes. One day, markets are soaring on optimism. The next, they're plunging on fears of recession. This kind of unpredictability can spook investors and make it harder for businesses to raise the capital they need to grow. Finally, let's not forget about housing markets. In many countries, home prices have been climbing for years, fueled by low interest rates. But now, as rates rise, we're starting to see cracks. If housing markets cool too quickly, it could drag down economies that rely heavily on real estate. All of these factors, debt, geopolitics, market volatility, and housing risks, combine to create a fragile economic environment. It's like a house of cards, where even a small disturbance could bring everything crashing down. Expert analyses in historical context. Now let's hear from the people who've been studying this stuff for decades. What do the experts think about all these warning signs? Some economists are raising alarms, pointing to patterns from past crises. Take the 2008 financial crash, for example. Back then, it was subprime mortgages, loans given to people who couldn't afford them, that caused the system to collapse. Today, the risks are different, but the fear of another domino effect is just as real. One of the biggest concerns is what they call economic bubbles. These happen when asset prices, like stocks or housing, rise far beyond their actual value. Eventually, bubbles burst, and when they do, the fallout can be devastating. Think about the dot-com bubble in the early 2000s. Tech stocks were the hottest thing on the market, until they weren't. The same thing happened with housing in 2008. Right now, some experts worry we might be in another bubble, driven by years of low interest rates and excessive optimism. With rates rising, the bubble could be deflating right before our eyes. But not everyone is predicting doom and gloom. Some analysts argue that today's economy is more resilient than in the past. They point to central banks, which have become much quicker at responding to crises. For example, during the pandemic, governments and banks injected trillions of dollars into the economy to prevent a collapse. Another reason for optimism? Diversification. In the past, economic crashes were often caused by problems in one sector, like tech in 2000 or housing in 2008. Today, economies are more diversified, with growth spread across a wider range of industries. This could make it harder for a single issue to trigger a global collapse. The debate among experts is fierce. Some say the warning signs are too big to ignore. Others believe the risk can be managed. Either way, it's clear that 2025 is shaping up to be a pivotal year. Counterarguments, reasons for optimism. It's not all doom and gloom. There are plenty of reasons to believe an economic crash can be avoided. For one, technology. Advancements in AI, renewable energy, and digital infrastructure are driving new waves of productivity. These innovations could provide the boost the economy needs to stay afloat. Then there's government intervention. Over the past few years, we've seen just how quickly central banks can act. Whether it's cutting interest rates or injecting money into the economy, they have tools to prevent a collapse. Emerging markets also give hope. Countries in South Asia, like India, are experiencing strong growth. These markets could help offset slowdowns in the US and China, creating a more balanced global economy. It's also worth noting that consumer spending, especially in developed nations, remains relatively strong. As long as people are spending, businesses can stay afloat, which helps keep the economy ticking. So while the risks are real, it's not all bad news. The economy might wobble, but it doesn't have to fall. The big question remains, is an economic crash coming in 2025? The answer isn't simple. On one hand, you've got rising debt, geopolitical instability, and market volatility. On the other, there are reasons for hope: technological innovation, government safeguards, and the resilience of emerging markets. Here's the thing. No one can predict the future with certainty, but staying informed and prepared can make all the difference. What steps are you taking to protect yourself if the worst happens? If you found this video helpful, share it with someone who might need it. Don't forget to subscribe to our channel and hit the bell icon so you never miss an update. And we love to hear your thoughts. Drop a comment below and let's discuss what the future might hold.